our tutorial on the dividend discount model for commercial banks. This is one of my own personal favorite topics because it is something simple but also something very powerful that you can use to value something other than standard normal companies by using a methodology other than your standard discounted cash flow analysis. So you can see the basic outline of the model here on screen as always, along with our starting assumptions over here on the right side of the page. What I want to do first though is explain why we use this in place of a discounted cash flow analysis for commercial banks. And actually with a dividend discount model, you can look at this for both normal companies and commercial banks. So it's not limited to commercial banks, but it's certainly much more useful in most cases for commercial banks because the concept of free cash flow does not apply to them. So since you cannot calculate free cash flow the normal way for commercial banks, instead you use dividends as a proxy for free cash flow and value the bank on the basis of the dividends they issue and then the present value of the dividends that they're going to issue far into the future. So let's start with why the concept of free cash flow doesn't apply. The first problem is that it's very difficult to separate operating versus investing versus financing activities for a commercial bank. The reason is that with a normal company, if they raise debt or if they issue equity, for example, well, that's clearly not an operational or investing activity. That's just how they're funding their business. But for a bank, it's completely different because first off, they have to keep a required amount of capital on hand at all times. So it is sort of an operational activity to do one of those. And then second, they're going to turn around and use whatever they've issued to go issue new loans to new customers. So the lines between these categories are very blurry and the traditional way of calculating free cash flow just doesn't apply. Another problem is that capital expenditures, CapEx, do not actually represent reinvestment in the bank's business as they would for a normal company. For a normal company, if they buy factories or equipment or land or buildings, they're doing that to grow their business. But for a bank, reinvestment in the business really means hiring people, doing more lending, training their existing staff to work more effectively or cross-sell more products or something like that. And you could try to capitalize the hiring and training costs, but in practice, it's almost impossible. You can't estimate a useful life of an employee. It's hard to standardize this. It's hard to come up with really good metrics around it. Whereas with capital expenditures, you can always just look at the cash flow statement. And then the third reason here is that working capital represents something very different for a bank. So when you subtract the increase in working capital or the change in working capital, whatever you want to call it, in a traditional DCF analysis, that works because current assets except cash and current liabilities except debt, that does roughly correspond to the cash needs of a business, how much cash is going to cost to grow, or perhaps how much cash it's going to throw off and generate as it grows. But for a bank, you have tons of other things in here like investments, securities, other types of borrowings, and you could see massive changes in this number, but that doesn't necessarily mean that a bank is required to do that to grow. That could just mean how they're choosing to allocate their capital to different types of investment strategies, different types of lending, and so on and so forth. So that's why a dividend discount model is important. Now, what we do instead is, as I mentioned before, we're going to use dividends as a proxy for free cash flow. So if you go up here, you can see the outline of the model. And normally what we would do is down here, instead of the present value of dividends, we'd have the present value of free cash flow. But what we're doing for a bank instead is calculating dividends, where we'll be backing into that number because, as we'll see, it's going to be constrained by a number of assumptions here. And we're going to back into this and calculate the present value of these dividends instead of the present value of free cash flow. We will still have a terminal value as you would in a DCF, but even that's going to be calculated differently because we're going to use a price to book value multiple or perhaps a price to earnings PE multiple instead. And the reason why we're doing this, as I just said, is that there are these Basel Accords, 1, 2, and 3, and the details get very complicated. We actually have a whole quick reference guide just dedicated to dealing with regulatory capital and how Basel 1, Basel 2, Basel 3 work, how different types of regulatory capital work, how you add them up. And if you look at a real bank's regulatory capital calculation, I have one for JP Morgan here on screen, it gets very complicated. There's a lot that goes into it. But basically, the idea is that banks have to keep on hand a certain amount of capital at all times to cover unexpected losses. So they expect to lose a certain amount on their loans and investments over time, mostly loans. So for a bank, the loans are on the asset side of the balance sheet. Well, if the value of the loans suddenly goes down, they're going to have to mark down something on the liabilities and equity side. And if they do not have enough common shareholders' equity, mostly retained earnings, common stock, and APIC, they may have to write down debt. They may have to write down the value of their deposits, which are owed to customers. So very bad things are going to happen unless they maintain a certain amount of capital on hand, just in case there are sudden unexpected losses. So as I said, there's a lot that goes into it. One of the most important metrics is Tier 1 capital, which is basically equal to shareholders' equity minus goodwill minus certain types of intangible assets. And we're not going to get into the full definition of all this here. I'm just giving you the rough overview, the high level ideas. But here we're going to be assuming that Tier 1 capital is essentially equal to shareholders' equity, again, which is in place to cover the bank's unexpected losses. So we're going to be assuming that. We're going to be assuming no goodwill, no other intangibles. And all banks have to maintain a certain percentage of Tier 1 capital as a percent of their risk-weighted assets, which basically mean how many of their assets are actually earning interest or could potentially earn interest. So they have some risk associated with them. So what we're going to be doing is assuming that a bank is targeting a certain amount of Tier 1 capital based on the rest of its balance sheet. It's growing its assets at a certain rate, its net income is growing at a certain rate, and then we're going to use those assumptions to actually project its dividends, calculate the present value by discounting them, summing them up, and then discount and add the net present value of the terminal value to get the company's total value. So that's how it works here. And you can see the outline I have for the different steps we're going to go through the process. We're going to start by making the assumptions, then project assets and risk-weighted assets, then net income, then shareholders' equity, back into our dividends, flesh out the rest of the model, and then discount and sum up everything at the end. So let's go over and take a quick look at our assumptions first. So I have some notes over here on the side. The minimum Tier 1 ratio of 12%, again, this is set by the different Basel Accords and also what the company has done historically. We're saying 12% here, which is quite a bit above the official requirements, which are anywhere from 4.5% to 7% to 9%, depending on the time period, the bank, the region, all sorts of other things. But we're just being conservative here. The total assets that we're starting with, $1,000. So obviously a real bank would have a lot more than this. This is in millions, so it actually is a lot more than this, but that's just our starting assumption. Growth rate of 5%. Generally, a healthy bank is going to be growing its assets and loans and deposits more quickly than the overall GDP growth rate. So overall GDP is growing at 3, 4%, 2%, something like that. Reasonable to expect a 5% growth rate for assets. The initial risk-weighted assets, so we're saying that 60% of a bank's assets could potentially earn interest or at least have some amount of risk associated with them. So these would correspond to loans to customers, they would correspond to certain types of investments, and so on and so forth. And then the return on assets and cost of equity. So return on assets is just equal to net income divided by the average total assets, which we're simplifying to just total assets here. And that is just a measure of how efficiently a bank is using its assets. So if return on assets is higher, if it's over 1%, let's say, that is pretty good for a large commercial bank. And it means that they're leveraging their assets effectively to generate net income and earnings. If, on the other hand, it's far below 1%, that means that it's not being very efficient or it's being very conservative or something like that. Cost of equity, I'm not going to get into here, but this is the discount rate that we're using in any type of equity value-based cash flow or dividend analysis. And the dividend discount model, of course, is based on equity value, so that's what we're going to use here because, of course, dividends only go to equity investors. They do not go to debt investors in the company. And this one you'd have to calculate based on comparable companies, which we're not going to go through. This is just a simplifying assumption. So those are our main assumptions. We have some others down here, but I'm not going to go into these. We just don't have time in this short tutorial. And I'm going to check off step number 1. And as I say here, in real life, of course, you base all these numbers on historical financials, channel checks, industry research, outside analysts, talking to the bank's executives, for example, but we're simplifying it here to save time. So step 2, projecting the assets and risk-weighted assets. We have our starting assets over here. What I'm going to do is take our starting number and then multiply by 1 plus the asset growth rate over here on the right-hand side of 5%. So we have that. And then risk-weighted assets, remember, these are a percentage of total assets. So we're going to take our total assets and then multiply by the risk-weighted assets as a percent of the total. We have that. And do we need anything else? Not really. Those are the main numbers we have to fill in for now. So let's copy that across. We have this in place. So we have our risk-weighted assets and our total assets growing over time, and we can check off step number 2. And then step number 3, project net income. So this one, ideally, you should be taking the average total assets and applying return on assets to that. We're going to simplify it a little bit and avoid a circular reference by just taking the previous total assets. So let's take our total assets and then multiply by our return on assets over here. Make sure we anchor that with F4. And let's take this, copy it across. So we have that. And what we can now do is go down and check off step number 3. And then step number 4, we're going to project shareholders' equity. So really Tier 1 capital in our simplified model here based on the targeted capital ratio. So remember, we are saying over here that our backup capital or buffer capital has to be 12% of the amount of capital that we could actually potentially have losses on. So that's what this is really saying, this 12% assumption here. So initially, if you look at this, we start out at 72 over 600, which is exactly equal to 12%. That's intentional. I set it up like that. And so what we're going to do going forward is the following. We're going to take our risk-weighted assets and then multiply by this 12% number, the minimum tier 1 capital ratio over here. Let's take this, copy it across. We have that. And so this is what our minimum is each year. And what this means is that unlike with a normal company, where you can just say, okay, dividends are some percentage of our net income, for example. So you could just say, okay, let's assume a payout ratio, make it equal to a certain percentage of our net income. You cannot do that with a bank because you have to meet this minimum shareholders equity, this minimum tier 1 capital requirement. And that's the fundamental difference. A lot of people miss this. It's super important, so I keep repeating it over and over here. So with this ending number in mind, we know our net income, we know our beginning number, and what that means is that we can now back into our dividends over here. So let's go down and just check off the next step to make sure we have this straight. And then step number 5, this is the critical step. This is the step that is different with a dividend discount model for a bank versus a normal company, and the most important step in this process actually. So for our beginning shareholders equity, let's just link to the ending number. Our net income, let's just link to the top. And let's copy these across. Now for the dividends, how do we do this? Well, we take our ending shareholders equity, we subtract our beginning shareholders equity, and then we subtract our net income over here. So we can issue 4.4 million in dividends in the first year. Let's copy this across. And just to check our math here, let's take our beginning number plus our net income and then our dividends to see that we add up to the 75.6, and looks like we do. So these match up. And so that was a very simple step, but also a very critical and important one, because think about it. What if we assumed something much greater than this number? Let's say we assumed 8, for example. Well, what we'd have here is our beginning shareholders equity plus our net income minus our dividends. That would be equal to 72. So our ending shareholders equity would be equal to 72. 72 divided by our risk-weighted assets. Well, this is only around 11.4%. Which if you look at it, it doesn't meet our minimum tier 1 ratio of 12%. So this is less than that ratio, and that's why it's critically important that you calculate dividends like this for a commercial bank when you're doing a dividend discount model. And of course, in real life, it gets more complicated, and you could have lots of other things that factor in, but this is just our simplified model to teach you the concept for now. So we have our dividends calculated. I'm going to mark off step number 5. And then step number 6, we're going to flesh out the rest of the model. I haven't listed this in detail because it's not as important, but we like to fill in a couple other things. So for net income, we like to fill in our net income growth rate over here. Then for dividends, of course, we can just link to our number down here and flip the sign. Copy that across. And again, we can have our growth rates. And we can also have our payout ratio. So that's just dividends divided by net income. And really, this is mostly for informational purposes more than anything else. And then we can also fill in our tier 1 ratio down here and our return on equity. So we actually already have these formulas. Return on equity is just equal to net income divided by shareholders equity, or average shareholders equity. We're simplifying it a little bit here. And so let's just copy both of these across since we already have them. And so all that's in place. And we also have our present value of dividends calculated down here. I didn't go through this formula because we just don't have time in this tutorial, but that's already been calculated. Now let's mark off step number 6. Step number 7, discount and sum up the dividends. Well, we've already pretty much done that. And step 8, that's what we're going to go into right now. So for discounting and summing up the dividends, we already have it over here because we have our summation formula that is linked to for year 1 through year 5. We've already taken the present value in each of them for each year based on the cost of equity, of course. The present value of terminal value here I'm calculating by assuming a price to book value multiple. We don't have time to get into the rationale behind this because this tutorial is already fairly lengthy, but that's how we're doing it. We're calculating terminal value based on that. The final year book value over here, 91.9. We're just taking that value and applying this multiple to it to get to the terminal value. And then present value of terminal value, as always, what we do is just take our year, our terminal value, and our cost of equity to get to that. And then we can sum up the dividends and the terminal value, the present value of both of those, to get to the overall company's present value. Now, the next and final step here is to look at the implied share price and compare it to the company's current share price. So diluted shares outstanding, I'm saying 10 million. So therefore the implied share price is just equal to the 62.9 divided by 10, or 6.29. Now their current share price is 550. What is that telling us? Well, let's take the current share price divided by the implied share price. We can see that right now the company's current share price is at about a 12.5% discount to the implied share price, which is a sign that this bank may be undervalued. And one thing I would really want to stress here is that this is not a 100% indication that it is undervalued. It's just a sign that it may be. You have to do further research. You have to look at the market, the bank's position. You have to try different assumptions, create some sensitivities. But this is an early sign that perhaps it is undervalued. If this were a premium to the implied share price, then perhaps the bank might be overvalued. But again, it's not an absolute indication. It's just one piece of the trail that you follow when you try to determine this and try to figure out if the clues say it's overvalued or possibly undervalued. So that's it. I'm going to check off step number 9. And just to recap everything we did here. So first, we started by explaining why free cash flow doesn't apply to commercial banks, because you can't separate operating versus investing versus financing activities. CapEx doesn't apply because it doesn't represent reinvestment in its business. Working capital means something very different. So what we do instead is use dividends as a proxy for free cash flow, because the company is constrained by its capital requirements, its total assets, its net income, and so on and so forth. To set it up, first we made assumptions for the total assets, asset growth, targeted capital ratios, risk-weighted assets, return on equity, cost of equity. Then we projected assets and risk-weighted assets over here. Then based on that, we projected the company's net income. And then we projected the ending shareholders' equity, the minimum each year, based on the Tier 1 capital ratio we're targeting. And then we backed into our dividends based on the beginning shareholders' equity, the net income generated in the year, and the ending number that we're trying to target. And then based on that, we had some other metrics, the net income growth, the dividend growth, the payout percentages, all that. And we got to the present value of dividends each year. And then finally, we went over here, calculating our terminal value, and we added up the present value of dividends, the present value of terminal value to get to our overall company's present value. We divided by the diluted shares outstanding to get to the implied share price. Then we looked at that versus the current share price and found that perhaps, at least with these assumptions, the bank is undervalued. The next step here, of course, would be to confirm this in real life, get better assumptions, look at it under other scenarios, and so on and so forth. So that's it for this lesson. What you do next is, in real life, of course, you do this for a real company. You look at their real historical financials. You would come up with more complex data and assumptions based on channel checks, industry research, speaking with the bank's executives, and you could add more advanced features. Other ways to calculate terminal value, more accurate regulatory capital calculations. You could add a mid-year discount or stub period to the dividend discount model. You could look at stock issuances and repurchases, because those are also going to affect regulatory capital, multiple growth stages. You could have multiple different scenarios. So there's a whole lot you can add, but at least now you understand the basic concept and the high level idea behind a dividend discount model for commercial banks.